Well, hello, everybody. Another week of the Investor's Guide to Thriving. And again, special thanks to all our sponsors and our partner companies. And really our partner in educating Canadians has been for many, many years, BMO ETFs. So thrilled to have them on. Tonight's presentation you'll find very interesting. We're in a period of high volatility for markets right now, and BMO's got some ideas to try to dampen that volatility. And if you do enjoy tonight's presentation and the whole series, please help out. We got some tremendous donations already from some of you, and I'm going to be thrilled to match those all. So thank you so much. And tonight, to kick things off here, is golfer extraordinaire. And one day, I think Chris will get out on the golf course and we'll see who the real golfer is Chris McGrath, my friend from BMO ETFs. And he's here tonight to talk about managing portfolio volatility with low volatility ETFs. So over to you, Chris.
Larry, thank you so much for that introduction. Very kind of you. Yes, I certainly look forward to the day where we can finally get together and settle the title. But for now, we're going to stick to managing portfolio volatility with low volatility ETFs. So first and foremost, as you all know, the disclaimer, tonight is not a recommendation. I'm not giving advice in any way. Just here to provide information and education on financial markets with a focus on ETFs and better ways for you to build portfolios. Next slide, please. So market volatility, something we're hearing a lot about in today's news, today's headlines, everywhere you look, TV, newspaper, telephone, etc. We're hearing about volatility, and what's really causing all this volatility that's out there. I think one, central banks, planning on increasing interest rates this spring. I believe the next meeting is in May. And, word has it that both Bank of Canada, the Fed, looking at increasing rates 50 basis points at a time here. So with rates going up, that certainly has been a challenge and a cause of market volatility that we've been seeing. Obviously, this is an easy one. When we go to the pumps to fill up our cars with gas, you go to Home Depot maybe to get some lumber for a renovation of some sort, the grocery store, we're all feeling that inflation. And with that comes higher prices. Again, that inflation, that uncertainty of the way things have gone and how it's affecting our daily lives, causing market volatility as well. And obviously the biggest headline news that we're seeing today, the geopolitical risk in the Ukraine and Russia. I mean, unprecedented what's happening there right now. It just felt like we were getting past COVID, brighter skies and sunny skies were ahead, and here we have this particular situation. So all these headline, walls of worry that we're seeing in the media certainly are affecting the market for volatility and investors' perception. Next slide, please. So if we look at the VIX, and this is a major measure of how investors feel about the markets and how they feel about volatility. The VIX is the CBOE, the Chicago Board Options Exchange Volatility Index, which is a measure of the volatility S&P 500. Now, to put that in more simple terms, I think it's a measure of forward-looking risk, not a measure of historical risk, but more forward-looking risk. And it's options pricing derived. So if we look at for example, the options pricing on 1 month forward-looking volatility, I believe today the VIX was around 21%. As you can see here from the graph, heading into COVID and at COVID, we saw that really significantly jump up, as you can see, getting a little bit north of 80%. So when we're looking at the VIX, it's a great barometer or an assessment of how investors are feeling about the markets today. So, higher values in the VIX will indicate greater volatility, which means investors are feeling more uncertain. And yeah, we're looking at 2022 and speaking with, and Larry, I'm sure you'll speak about this at some point, but a lot of our portfolio managers feel that we could continue to see the VIX be relatively high here, and as we go along here in 2022.
Well, it's pretty clear, Chris, from this chart. If you look at the pre-COVID period, and you take an eyeball and you draw a line on an average line, you get somewhere between the 10 and 20 range. Obviously, there were spikes and valleys, but if you draw a line post-COVID, you're now between, say, the 20 and 30 as an average, or certainly above 20. And I think that's a notable uptick in average volatility, and it has to do with a lot of the uncertainties that you have already talked about.
Yeah, thank you for that. So if we look at some of the key terms to describe volatility in a stock or an ETF, which we're speaking about today, I think beta definitely would be point number one. And beta is a market relative metric. So look at it this way: if the market has a beta of 1, and we're looking at a stock that has a beta of 1, one thing that we could conclude from that is that that stock will move in tandem with the broader market. So as we can see here, the 1 indicates a less risky stock versus the broad market. So in our low volatility methodology, we're looking for stocks that have much lower beta than 1, for example. In some cases, it could be 0.3, 0.5, 0.7, and so on. So that's really what we're trying to achieve in a low volatility methodology. Now, the second key term that we like to think about or talk about is standard deviation. And that is not a market relative term. You could look at a stock and the price history. So for example, we might look at Apple stock, we look at the price history of how it's performed or how it's done throughout, say, the month of January 2022, and we can look at that standard deviation of that stock as a statistical measure of how that stock varies from day to day. And I think one thing that's worth pointing out, Larry, as well for our audience, when investors are looking at an ETF risk rating on, say, the BMO ETF roadmap or one of our competitors, for example, that risk rating that you see that is given to that ETF does come from the standard deviation. So something really important to know there. So if we look at how ETFs can mitigate portfolio volatility, I think this is really a great example. If we look at the single stock risk, or maybe owning 3, 4, 5 names of particular stocks, we wanted to show by owning the ETF, in this case ZCN, versus say Royal Bank or TD, or again some of the largest names that we see out there and some of the major names in the headline news. Look at that volatility. Look at the differences, the delta that we're seeing. Royal Bank, January 2022, from when we pulled this data, 8.9%. But if I look at Shopify, wow, big difference, minus 29.3%. If I look at the basket, if I look at the broader index in ZCN, minus 0.4. So we can conclude that by owning the ETF, it does offer that broader diversification, and you're not going to get these big swings like we're seeing in some of these particular single stock names.
People like the swings when they're to the upside, but not as much when they're like Shopify recently.
Yeah, absolutely. When the losses are there, it certainly raises a lot of attention, that's for sure. So if we take low volatility a step further, we've heard the expression kicking the tires or looking under the hood. I think we have to be careful, because you could look at, hey, you know what? I'm going to go onto my internet here and maybe do a screen for volatility, low volatility. We assume, maybe as investors, that all low volatility is the same, but it's not. And we have to be aware as investors of these smaller details, things like standard deviation that we've talked about today, beta that we've talked about today, optimization is another component, and weighting. Is there any constraints when it comes to low volatility stocks? And I think, are there other factors that are being considered? And when we look at a factor, that's just an approach to the market that, may differ from market cap weighting of the market itself. So, in this case, you could have a single factor, such as, our low volatility. You could have a multi-factor where you're getting a low volatility methodology in addition to a quality factor. So it's really important, and I love this slide, it's really important to look under the hood, know what you're buying, know what you're getting into when constructing portfolios with low volatility. And if we look at diversification versus the broad market exposure, so again, we're going to use ZCN, and just to highlight that, that's the BMO S&P TSX Capped Composite Index. I think right away when I'm looking at this, there's a couple things that come to mind. If we look at the broader market right away, we can look at energy, coming in around 15%. We have utilities, materials, coming in around 11.2%. So just on maybe, let's focus on the materials and energy. Let's call that around 26% in those two particular sectors there alone. But if we swing over to the low volatility, ZLB is the ticker. Well, one thing that I can conclude right away, okay, so there's some energy, but no energy. There's no energy at all in the low volatility, but there's only 7.75. Let's call that 8% in materials. So quite a difference there when you're doing the comparison. And again, our methodology is to screen by beta. And one thing that jumps out to me again, the hydro one holding there, as we can see the utility. And I think one thing that's really interesting as well is when I look at Metro, when I look at Empire, when I look at Loblaws, some of the grocers there, these tend to be maybe what we might call a boring stock or a boring holding. But again, if you're looking at a longer term horizon, these stocks have been very sustainable and have performed very steadily over the course of time. So that's why you're seeing these particular names in the portfolio versus, say, switching back to the ZCN where that's not the case. So I think this is a really good example of the two side by side. Next slide, please. So again, a picture's 1,000 words. As we know, an example of low volatility performance. Just to be clear, the blue line is the BMO S&P TSX Cap Composite Index. So that's the market. The orange line is the BMO Low Volatility Canadian Equity ETF. As you can see, green, Invesco Low Volatility, and the purple is the iShares. So again, going back to what I said earlier about looking under the hood, I think this graph really shows a lot of things. And again, going back to my grocer example, if we look at that period, from June, May, et cetera, of 2019, moving forward into COVID, I think sometimes people think of low volatility as something that's not going to perform well. But as you can see, look at that orange line. I wanted to highlight, look at that outperformance. It's actually done very, very well, outperforming the market in this particular case. And if I was to look at the return of the 1 year, you can see the index itself coming around 25%, us coming around 25%, the Invesco coming in around 10. So I think this is, again, where we don't want to generalize that all low vol is the same. And of course, the iShares coming in at 25.9%. So I think, that this picture really shows the added value in performance. And talking about low volatility, I also wanted to highlight the downdraft. So again, looking at that orange line, the downdraft, or how much it has fallen from peak to trough, isn't as much or as significant as, say, the broader market and some of our competitors that are in this example. Next slide, please. So just to kind of round out all this discussion, I just wanted to highlight in our low volatility suite a couple things to look at here. ZLB is our BMO Low Volatility Canada, BMO Low Volatility US, ZLU, the unhedged, ZLH, the hedged. And I'm happy to say it does come in a .U, that's a US dollar version. We also have the Low Volatility International Equity. You can see the tickers. And I'm very proud to say, Larry, and share with the audience, our strategy is award-winning and is the largest low volatility ETF in Canada with over 3 billion assets under management and over a 10-year track record.
Yeah, I think it speaks to the low beta factor that you're weighting in, I think, compared to some of the other ones where they're not considering beta as a key consideration.
And that's been very reflective of that long-term performance. Thank you. And just to kind of close things off here, before I hand it back to you, Larry, ETF Market Insights webinar coming up again tomorrow, Friday, March 25th at 1 p.m. Please join us. I encourage you, if you can, make the time to be on that webinar. You can register at etfmarketinsights.com. And the topic will be breaking down Q2 earnings by Danielle, Alfred Lee, and Chris Heaps. So with that, thank you again, Larry, for having me back. Always a pleasure to be with you on the show here.
Well, thanks very much, Chris, and we'll look forward to golf this summer. Although I have to say, I do have to have back surgery, so not making excuses, but.
Well, thanks for letting me know. Well, I'll be sure to maybe give you a couple strokes.
Excellent.
Okay.
Excellent.
All
okay,
right.
We'll see you soon, Chris.
Thanks, Larry. Appreciate it.
Okay, so what the banks say here and their reaction to net interest margins is a big consideration. And when we talk about the yield curve and what it means for investors, that is a big factor. So this week we're going to take a bit of a deep dive for you on the yield curve and what it means for the business cycle and credit cycle markets. Because if you've studied economics in any great length, you will know that the GDP of the economy is basically what we all earned collectively, and so that's the income side of it. And then what we spend is the sales side or the production side. So what's being produced in the product, gross domestic product, and then so everything else that's above and growth higher at higher rates typically comes from the expansion of credit. And then when we go into recession, the contraction of credit. And that's why the yield curve and credit cycles are important, because that's the cost of money, what interest rates are. And now we're in a rising interest rate environment, and it may mean more volatility in your portfolios. So as Chris said, I'm going to take a little bit of an excursion for you on how you can make your portfolios boring for the next few years and avoid some of the more volatile areas. But I want to talk about the geopolitics of the world at the moment. And, I think what Putin has done here has, past the point of no return. One of the geopolitical firms I look at is the ISI group and what Ian Bremner has developed, and of late a free video service called G0 Media, Ground Zero Media, and I think they put out some excellent stuff. I've been tweeting it and reposting on my social media channels from LinkedIn. So this is a clip that they had put on LinkedIn just the other day. The atrocities that China did when they had the uprising. A lot of people think the only way Putin comes out of power is from within. And I kind of believe that. But when the people rise up, you have the risk of what happened in Tiananmen Square. And for those of you who not old enough to remember what it is, I put a link in here, and you should really look at it, because it was a shock to the world, where the government literally opened fire on its people and killed them. You know, Russia has used gas. They are an authoritarian government, and it's frightening. But I do not think that Putin's army is strong. First of all, his army's not strong enough to take the Ukraine. Now, ultimately, they probably will, but the supply chains feeding the people, the bad or insufficient supply chains. It's embarrassing, frankly. The Russian war machine here is so weak. I don't think stepping a foot into any NATO-backed country is an issue. And we talk about this. You know, wars are generally fought over ideology, and I think we have to believe in the freedom narrative, and neoliberalism has to win in the long run. But one of the things that the neoliberal model has created is a massive inequality. And that's where capital share of income is beginning to dwarf labor share of income. Basically, what that means in English is people with money, their incomes are going up, and people with labor skills, their incomes are not going up. And that, to me, is the bigger war here, that inequality being fixed. And to me, that's incredibly inflationary. So we're heading into a world, I believe, where labor and the average person is going to get stronger, having 50 years of the opposite. And I think it's something we need to be aware of, that it's going to get a little bit stickier here. So let me try to play this video, and hopefully it works for us.
We are beyond the point of no return. Will there be an escape route for Putin? I would argue no. I mean, it's impossible. The only thing that he understands is power and force, I'm afraid. He's not going to back down. So, you know, what we need to see eventually, I hope, is regime change happening from the inside. The problem, of course, there is that historically, when there's regime change in Russia, you get the hardliners in first. That's what happened in 1991. So we don't want that. It's, after all, a country that does have nuclear weapons. So to try to get some kind of a pathway out for Putin, you know, he can't lose face in front of his own. So therefore, it's going to be very difficult to find a solution on that.
Now, a lot of people say that he can't lose face, but at the same time, of course, Putin completely controls the narrative domestically, much more so than any American or European president. He's gotten rid of all the Western media. He's gotten rid of all the local Russian independent media. Can't he sell whatever story he wants to sell? I mean, there are a lot of Russians right now that believe that Ukraine was engaged in acts of genocide against Russians in the Donbass, something that is obviously ridiculously untrue.
Yeah, I mean, I guess the starting point here is to understand that Russia has always, ever since the Romanovs came in, the Tsar family, after an era of unrest and unpeace, if you will, they've been led by a strong leader. The system is very hierarchical. You have the leader, and then after that, you have sort of a pyramid of his or her princes. They sort of make sure and back up that the leader can do whatever he wants to. So the narrative in Russian history has always been that the rest of the world is out to get us. So that Russia, the biggest country in the world geographically, is somehow surrounded by enemies. And throughout history, the enemies have varied from, you know, the Mongols to the Japanese to the Europeans to the Americans, and right now to NATO. So yeah, I'm sure he can push that narrative. But at the same time, you know, we do live in a connected world. And at the end of the day, Russians will get the information in. Right now, they don't have narrative is crude. Final point on that. Remember that for Russia, there are 3 words for truth, and one of them is tactical truth, pravda. And that basically means that you can give not only a white lie, but a blatant lie, as long as it's tactically useful for the good of the whole, in other words, Russia. That's why the Russians are now believing in the propaganda that they hear. What I'm sure about in the next 10 years is that if Putin is there, Russia will be utterly, completely, and fully isolated. The sanctions are there in the economic field, in finance, in energy, in transport, in sport, in culture, in anything that you can imagine. So we're basically getting this enormous North Korea or Iran or South Africa when they had sanctions on. That is the future that I predict for the next 10 years from a Western perspective.
Well, you know, the world is going to remain a challenge, and I think ultimately Putin comes to the table to negotiate. But again, it's not going to be until he has control of Kyiv and ultimately the country. So this is going to drag on for a while. Today's the 1-month anniversary, sadly, of the launch of the war, and it surprised a lot of people. So, you know, let's take a little dive on the cost of money here and yield curve and credit. And so I featured this chart on the show this week, but sadly my producers didn't get my cues right, and I didn't get to talk about it in depth. So I wanted to dig in here a little bit. The orange line on top is the 10-year bond yield. When banks lend money, they tend to lend for term, whether that's 2-year loan, 5-year loan. They tend not to do much longer than that, but 10-year loan. So the cost of financing is almost and inevitably a floating rate. The banks don't borrow a 5-year bond and lend at a 10-year rate. They just don't do that. They borrow short. Their short-term risk is the floating rate. They can hedge that with money market instruments in the LIBOR markets. There's a robust capital markets in the euro-dollar curve, soon to be replaced by a new series of funding mechanisms. But nevertheless, it's the same. So when we look at the funding markets, it's say under 1 year to lending markets, which tends to be 2, 3, 4, 5, and kind of longer term. So when that curve inverts, when the green line, the bill rate, is higher than the lending rate on average, what that means is net interest margins squeeze. And when that curve inverts, it's less profitable for the banks to lend, so they lend less. And that has a direct impact on the economy. Now, you probably heard economists talk about this measured and lagged approach to monetary transmission. What that means is they raise rates today, but that loan was done a year ago and doesn't have an impact until the loan matures a year or two from now. So there's a measured lag input to them raising rates. And so they always tend to overdo it because they're looking here and now at the data, but the lagged impact is really hard to measure. And what's different today than other past recessions? So this has the yield curve going back, 50, 60, 70 years, and the amount of debt outstanding. So the cost of financing the level of debt in the 1970s, because interest rates were much, much higher overall, was almost equivalent to what it is today. But today we have 3, 4, 5 times the amount of debt outstanding as a percentage of the economy, but interest rates are lower. Interest rates can't go back to those high levels. So we have better hope that inflation doesn't get sticky like the 1970s, where interest rates have to go up, because the economy would absolutely collapse. Can you imagine the young home buyer that just purchased and stretched to buy $1 million home, which is the average cost in the GTA, and put their minimum down of 100,000 or whatever, CMHC guaranteed, and they've got a $900,000 mortgage at 2.8%. So you do the math on that and they're all good. But if interest rates were to double or triple and all of a sudden that mortgage is 7 or 8% when it comes to refinancing after that term is done, how much of their paycheck now needs to go to finance that mortgage? And the answer is a lot of people aren't going to be able to afford their homes. Flood the market, prices come down. By that point, the economy is already deep into a recession. And this is why interest rates can't go up. So the Fed this week showed us their terminal rates and where they think interest rates are going to, and last week. And they think by the end of this year, the hawkish talk is that they're going to be able to raise the overnight rate to 3%. The last interest rate hiking cycle, that green line rising there towards the orange line, was in 2018, and they got to 275. Now, inflation then was not the threat it is today. And inflation then was a stronger economy driving things, not the supply side constraints with labor because of COVID, because of the aging population and more people taking early retirement, and because of Buy America. Now, less, microchips are now an important commodity that they can't rely on China to produce, just like the healthcare issues because of COVID. So everything's got to be onshored as opposed to offshore. That's going to create more jobs. So there's a lot more jobs available in the States. There just aren't the qualified people to fill them. So you've got this gap, and that means they've got to pay more for the labor to fill those jobs. And so inflationary ultimately means pressure on margins. So when we talk about the yield curve and the credit cycle and the expansion and contraction of the economy, if the cost of money goes up and the yield curve inverts, because the only way the Fed is going to slow this inflation, because they can't all of a sudden mine more material, because Russia produces so much nickel and wheat. Did you know that Egypt, 70% of the wheat in Egypt comes from Russia? And now they're not going to be able to get as much, and all of a sudden a loaf of bread in Egypt. And do you think that's going to cause a problem socially? And so you've got all these knock-on effects that are going to come because of these issues. And it's just going to be a big challenge for the world. And I don't think interest rates are going to go up much before the economy falls off a cliff. And wow, so we've got a couple really challenging years ahead of us, folks. And the growth stocks that are pricing in growth in earnings over the next 10 years today, and I'll use Tesla as an example for this. Tesla's costs are going up rapidly for batteries, for aluminum, for everything that goes into the car, including labor, although most of it's robotic, as you'll all know. Elon Musk has gone out and secured resources so that they can produce, but everybody's telling you we can't produce enough. We have the demand for it, but we can't produce enough. So these supply side issues are not going to be fixed by them raising rates. That is the conundrum today. So, what does that mean about, what's the credit cycle all about? And so when the economy's expanding, banks are lending, it's profitable for them to lend, their credit standards aren't high, and so money is easy. And so when we go into the opposite side of that, when money starts getting tight, you heard the concept of financial conditions. 50% of the financial conditions index is the S&P 500. So the Fed put comes into play and them flipping. How easy is it going to be if inflation persists at 3 or 4% a year from now to get easy again and start QE? And the answer is not very easy. So if you think the economy is going to look good going ahead, then let's have that debate. And so, let's kind of have a look at that. But credit right now, there's very little sign of stress. And after the great financial crisis, massive signs of stress. There are pockets of it. Credit default swaps, for example, for certain companies that are linked to Russia, big default risk coming and so forth. European banks, we're starting to see some of that stress. The market's rallying and ripping here. You've probably heard Wall Street start the narrative of bonds being bad and there's no alternative, and equities are a hedge against inflation. Oh my God, I want to get into the TV and punch these people in the head for not lying, but creating a story to support the sales activity of kind of what they do. And anyways, a year ago, so what we're looking at here in the light blue is the yield curve, a year ago, printing this off yesterday. So a year ago yesterday. And the very dark blue is yesterday's yield curve at 8 in the morning when I created the graphic versus 1 month ago. And you can see what's happening in the curve. So as they're getting more hawkish and they're talking about raising rates, the curve is flattening. But banks don't borrow at the 5-year rate and lend at the 10-year rate. Banks fund themselves in the money markets and lend 2 years and out. And the steepness there is still pretty steep, okay? And to me, that's the important part. And by the time the yield curve inverts, with the lagged impact of that transmission through the economy, the equity market typically doesn't respond negatively for a year to 2 years. So there's no recession on the horizon today based on my analysis of the yield curve. But 2023, late 2024, that's where it's setting up. So we'll see how much they're able to raise interest rates here in the coming quarters and how the equities markets respond to that. But it's not going to be good. If you think the stock market can break out to new highs here, we've got a bet to make, folks. So the Wall Street guys that think we can go to new highs here, I want to talk to them and I want to have this debate and what is motivating them other than the fact that the guy that pays them to be bullish on average. So let's have a look at that. But what our ProEyes indicator does is it basically says, what is that funding, what is that yield curve telling us about the funding versus the lending part of the curve? So again, I'm looking at the money market relative to the 10-year, not the 2s, 10s. Money fund, and right now, the funding markets are still pretty healthy. Okay, so we don't need to worry about this. There's all kinds of issues with supply chains and all that are causing all kinds of other economic stickiness and inflation problems that COVID really, accelerated. But Industrial production numbers globally are starting to improve with the reopenings. We're starting to see some of this variant rip through Hong Kong and some other places here. I'm hearing when they're analyzing the wastewater in New York that 20% of people in New York now apparently have this variant, but it's not, it transmits a lot. But because the vaccination rate is high or you've had COVID before, it's not causing the hospitalizations. So they're a lot less worried about COVID from the death rate perspective, but govern yourself accordingly because COVID is still out there. It hasn't gone away. You know, I was at the Leaf game last night. Nobody's wearing a mask or very few. And so, you know, we're all going to get this variant of COVID, I think, unless we're wearing masks. And, you know, but we're the likelihood of hospitalization is significantly lower as we go. So let's look at the credit side of things. So how I look at credit is what are the good companies basket? So single A type corporate, triple B type corporate, good, high quality corporate investment grade relative to the junkier companies that have bad balance sheets. And what's the relationship between high yield and what's happening in the stock market on a trending basis over the last month? That's what this little red line is here. And so what we've seen here is the stock market bounce over the last month as we get excited about the war not being so bad and earnings are going to be okay and companies are saying, you know, good things for now. And so the stock market has bounced here. The credit market, to the same extent, has not. And there's this little divergence there. And so what that means is the weaker quality credit is starting to widen out, not in a panicked way, not like what happened with COVID, but we're just starting to see that divergence in credit. And that tells us a little bit about credit cycle. Now, when spreads were really narrow and junky companies were trading for yields that don't pay you for the quality of investment you're making, that's to me where the risks are higher. So in our Pro Eyes indicator on the credit spread part of things, when credit spreads are narrow, that usually means financial conditions are good. But really there's a risk there. And so that's a negative. And so as spreads widen, that becomes a positive. But we want to see the spreads widen far enough and wide enough that it's attractive. And we're kind of not there yet. And so it's not low credit risk, but it's being compensated for that credit risk. And so credit is still a bit of a problem here and would be an avoid for me. So, you know, last week, LPL, good company in the US that's a platform for investment managers and what's called a registered investment advisor, like a financial advisor here in Canada. They're registered to, and they put you in a model portfolio and such. And so LPL is a big firm in the US, and they put out some research. And what they did was they went from 1980 onward and looked at all the recessions and said, don't worry, the stock market's always up 3 months, 6 months, and 12 months later. We're okay. And what they didn't do was peek into the 1970s where the inflation issue, remember, inflation was broken, inflation was falling throughout all this period. That's not the case today. And they haven't broken that back of inflation yet by inverting the yield curve. But what they're saying here is on the date of the first rate hike, don't worry, because of that transmission of monetary policy takes a while, that we're okay for another year or so. And that's been the case in history where Maybe in the first 3 months, there's some volatility and maybe half the time up and down. So the next few months, still some uncertainty. The next 6 months, there's still some examples of where the markets weren't higher from the first rate hike. But a year from now, we should be good. And what I'm saying is, if you look at the 70s, that was not the case because inflation was stickier and not falling on average. And we now have that dynamic where labor is going to get stronger. Again, this is a good debate to have, folks. So let's have it. Okay. Profitability of the banks, because at the end of the day, net interest margin matters. And what I did was I took a sampling of regional banks in the US and looked at their reported net interest margin. So when banks report tomorrow, stay tuned for that bank reporting webinar that BMO's doing. When banks report, they report their net interest margin. And in the US, far more profitable than in Canada on average. So that's very interesting to understand. So the net interest margin on trend over the last 30 years, you can see the trend is down, right? And so right now, banks have still very profitable, but relative to history, pretty much at the lowest point they've ever been at. Here's very interesting in Canada on their net interest margins. So when we look at the big 5 banks here in Canada, and you look at that, the trend is still lower, but really in the last decade or so, it's kind of hung out in the, call it 1.5 to 2 range on average, but still the lowest profitability. Why banks are still attractive is what's happened over the last 30 years is the fee revenue a bank charges relative to the lending part. The fee revenue is going up and up and up and up and up and up. So their pretty much guaranteed revenue has increased significantly compared to the profitability of the lending side of the banks. And I had this discussion with Jerry McGaughey when I was an analyst for a bank in a previous career. You'll all remember me maybe from the early 2000s where we first started doing the Berman's Call video hits on BNN, and I was a guest on Market Call before starting Berman's Call after I left the banking world in 2007. And folks, today is the 15th anniversary of Berman's Call. So really excited to have been out there educating Canadians from the very first days of BNN being on air, and I was a regular guest on Market Call, and then we started doing these little 5-minute interviews where I talked about all kinds of macro issues. But I remember back in 2005 having lunch with the then CEO of CIBC, and we were talking about what was going on in the world and the lending funding markets, and we had a very interesting conversation. But for decades now, the bank model has been to increase their guaranteed fee and have less sensitivity to interest rates. And that's been the case in Canada, not as much in the US. And when you have a capital markets division where you have the investment management piece, again, the guaranteed return coming off of that as a percentage of assets under management makes earnings a lot more stable for the banks. So, something to keep in mind here, and maybe they'll talk a little bit about that on the BMO webinar tomorrow. Here's where I think some of the issues are related to the war. And Barron's over the weekend had a great article out. I put a link here for you to see in the when the PDF comes out for you. You can dig in here. And they said, how do you combat your portfolio around food inflation? And I agree with a lot of the names. Many of the names, Agco, for example, is one I currently own in my stock portfolio. And those stock portfolios aren't available in BMO funds. These are portfolios that we manage for the Q Wealth platform, and any of the financial planners and advisors on the Q Wealth platform have access to those portfolios. So AGCO is one of the names currently in our universe, but Deere, Bunge, Kroger, Albertson's not in our universe, but currently when we filter for the stocks we want to own, all these names, not all of them, many of them come into our portfolio. So currently I own ALCO. This is an interesting graphic. This looks at the Deutsche Bank Diversified Agricultural Index. And it's using the futures contracts and what they call the excess return index. So how they manage the futures role is important here. And so they're tracking this index: wheat, corn, beans, coffee, all the foods, except cotton is part of the agricultural part because it's agricultural in its essence, but it's not a food like all the other ones here are foods. Okay, so food inflation is possibly the complex part of the Russian-Ukraine situation, where they produce a lot of the raw commodity, wheat in particular, sunflower. Ukraine, I heard, produces 70% of the sunflower in the world. Well, if they can't get their supply chains to export because of the war going on, it could be several quarters of food inflation, and not to mention the base metals and a lot of other the key things like ammonia, microchip, big input there, neon gas that comes from Ukraine and so forth. So commodity exposure is interesting. But when I look at previous spikes over the last 30 years compared to what we've seen so far, you think there might be a lot more upside here. So getting exposure to companies that might benefit from this is what this article is kind of a little bit about. And so within the article, they looked at, earnings and multiples. And right now, I do not like high PE stocks. So, here's a list of companies where they have relatively low PEs. There's not big dividends here, but that's pretty common in a lot of US stocks. So you're not clipping coupons here, but there's some good value in some of these names. And if you want to make your portfolio boring, a lot of these names are good names that would fall into those low volatility ETFs as well that Chris had talked about earlier on. Now, there's a couple names here which I wouldn't own today. Is Starbucks. Starbucks trades at a premium multiple. It's been a growth story for a long time. It's a great company. I can't figure out for the life of me why anyone would pay $5 for a cup of coffee, but I'm a Diet Coke drinker, and my wife will wonder why I drink 6 of these a day and, would pay $3 for one of these, right? So, I get the idea, but the premium multiple in the inflation period we're going into, Starbucks, at $50 or $60 starts to get interesting for me, but right here would want no part of it. So a little bit boring, plays in the food space. Coffee was one of the commodities where there's issues and price pressure. Sugar is another input. Milk would be another that kind of falls into the Starbucks basket, but I wouldn't own it at this price. But some of the food restaurant tours, not my favorite space. I was buying Cheesecake Factory is one of the names I like in this space, in the food restaurant space. But I recently sold my position out and I'll buy it back on some weakness. The food companies, the staples. Now here's where there's some interesting. General Mills and Kellogg's. I don't own General Mills. I've got puts written on Kellogg's to buy it a little bit lower. Again, notice the lower PE. I'm tilting towards some of those names right now. Hostess, Twinkie, higher PE right now. Not a lot of interest for me in that name. No dividend to speak of. So, my preference here would be to lean to a Kellogg's. Hershey, great company. Big global name in this consumer staple space. pretty expensive here, not a lot of yield in it. It's a name that's got to get cheaper for me to want to own. And that's kind of how I think about some of these things. And the other aspect of what the Barron's article talked about was how to participate by way of playing some of the commodity ETFs. So DBA would be the way to go to play the broad basket, but they're recommending corn and wheat. I recommend the average investor do not do this because you're trading commodity futures when you're doing this, because that's the underlying holding. And if you look at a long term, you understand very quickly that trading futures contracts and holding them for long-term investors is a bad friggin' idea. Don't do it. But if you understand how they work and you can trade them and not be emotionally attached to them when they go underwater, and you tend to hold them and hold them and hold them and let the futures roll kill you, you don't want to do that, folks. So there's some names in that article I like to help make your portfolio a little boring. Here's some other ideas for you. I've long said that Europe is broken. There can't grow there, but if you're going to own it, own some of the best dividend paying companies there and clip the coupons. And for years on BNN, since ZWE was created, and that's what the charts we're looking at here, I said, extract the dividend, get the covered call overlay, own the boring experience. And some people are looking at the blue line and saying, Larry, you've been recommending this ETF and it really hasn't grown. Europe's broken. There's not a lot of growth there. You're buying boring, good companies with high dividends and a covered call overlay. And what you've earned from the beginning is the orange line. And that is the 6% or so yield coming off the portfolio with not a lot of capital gains. And when you do go into a recession, it goes down. The volatility goes up. The beta. These don't guarantee you a smooth ride. When the volatility goes up, the lower boring stocks go down less, but they go down. And so you want to make your portfolio boring. You want to clip the coupons. You want to get the covered calls. For Europe, ZWE is the way to go. And if you want the currency exposure to the European currencies, which I've recently flipped to, ZWP is the way to go. And I have this as the exposure in my ZZZD Sleep at Night dividend portfolio. And in the same regard, boring, coupon clipping exposure. And there's a lot more value in international markets. ZWU is a name that I've said for years, and sometimes it goes through a bad period where it goes down and people send you hate mail and they say, Larry, you told me to buy this and it's going down, and blah, 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 blah. Yeah, it goes down during bad periods, but on average, you're clipping a very nice coupon. Your average return over the last decade has been 5.5%, and the volatility on average is below 10. It does go through periods. It's got pipelines in it. So when oil companies aren't doing well, like 2015, 2016, the volatility goes up. And when you go through a shock like we did with COVID, the volatility goes up. But on average, the volatility is below 10. The VIX of it is below 10. So you get a smoother sleep at night ride. Now, recently, I've got this out of my portfolio because I got more into Europe and emerging markets after the recent sell-off, because I think there'd be more upside there. So we tactically move the money around, but this is a nice, boring, coupon clipping holding. It is not a bond replacement. It is not fixed income. It is not credit. This is equity market participation and risk. And what I'm trying to show you here is how to make your portfolio a little more boring so that you can clip the coupon, get the yield you need to live off of, and do it with a little less risk. Because in the traditional bond world, you can't do this. And so when you own this portfolio, here's what you hold. And you hold some great companies, and they go up and down as markets go up and down. And recently, Verizon was trading at 55 and it's now at 51 and change. They go up and down, and I'm adding to Verizon in my portfolios right now. And AT&T that was trading at 28 recently cut the dividend, and now it's trading at 23. I love it at 23. I'm buying it in my stock portfolio here. I don't own any BCE at the moment. I don't own any Rogers, and I don't own any pipelines. But I do own a few. I own Kinder Morgan until recently. I sold it into the strength. And I'll buy it back when it gets back to a risk-adjusted level for me. And that's kind of what we do in our funds, in our portfolios. So let's lower the sensitivity to higher rates. Great article here in the Wall Street Journal. Not everybody's going to have access to Barron's in the Wall Street Journal. I pay about $500 a year or something, $300 US, something like that a year for access. They've got some great articles they publish, they give you names. This is like having a research analyst because they evaluate the research at Wall Street and they write reports on it. You're not early on these, but there's some good research. They give you some good ideas, some good names, and you just got to figure out how they fit into what you want to do as an investor and how you should run your portfolios. So with a bond of coupon of 2%, it's getting very, very difficult. So what they did in this report that looked at a low duration basket, boring stocks, low volatility stocks, compared to a high duration basket where they don't have stable earnings, they don't have a good multiple, and what happens during rising rate environments. And what you end up seeing is that boring stocks in a rising rate environment do better. Okay, so let's, for the next couple years, folks, make our portfolios boring. Try to own less of the exciting growth companies. We'll come back to them next year, the year after, when that recession comes in and the value of those companies are a bit more down to earth. You've seen a lot of the ARC, Cathie Wood, great companies. They all got more work to do on the downside before they're investable. They're tradable, all of them, but investable by what I mean by investable is you buy it and don't think about it for a few years kind of thing, as opposed to trading it where you're actively involved in the name and so forth. So folks, let's make our portfolios boring. Let's have less growth and duration. Duration in a stock is how long does it take by way of dividends and income to get your money back from that company? And a company that doesn't have profits today, that might in 3 years and might in 5 years, and they might be great one day, but until that certainty of that earnings goes up, and that requires good credit markets and good capital markets, and not the Fed raising rates and going to cause a recession. Make no mistake, the Fed is going to make a policy mistake and there will be a recession. And if I was Kramer, I'd be throwing things at the screen right now. I'm not guaranteeing you this, folks, but the probability based on what the Fed is telling us in their hawkish remarks and how aggressive they want to be, not to fix demand-driven inflation, but the supply shock sets us up for a bad experience. Now, it's going to be important as we get into earnings season that just started and really doesn't start in full blown till the second week of April. But we're getting closer to that. FedEx reported They talked about labor issues. They talked about wage pressures. They talked about energy, all the things that Chris talked about as being inflationary issues as to why we want to make our portfolios a little bit boring going forward. You can go to cash if you like, but cash doesn't pay you anything. And I'm going to do another webinar on private credit again, probably this next week coming up, because alternative sources of yield are going to be very important. And we built a private credit fund that is not available publicly, but I think this asset class is so darn important that people who don't want to take the equity risk can find places to get that yield that is a higher rate than inflation. And so that'll be pretty interesting. So let's get into the Q&A here. A lot of great questions have come in. So I'm moving my portfolio to actively manage ETFs, and that's why I hold ZWB, Banks with a Covered Call, ZPay, that ETF that I was involved in creating, and the ETF that I run, ZZD. I have held HAC for some time, and I've done well with this ETF. Your thoughts, please. So let me bring up, and let's have a look at what HAC ETF is all about. So Brooke Thackeray, Brooke's the portfolio manager that runs this fund, and it's seasonal rotation. So what is the current fund? It's 31% Canada, the Horizons Canadian ETF, 19% equal weight Canadian banks, TSX 60, so more concentrated portfolio in Canada, some gold shares, some US industrials, some real estate. I'm not sure if this is 100%, on par, but it's probably updated monthly. And so fund holdings as of the end of February. And so again, is this something, well, based on Brooks' seasonality work, this is how the portfolio should be positioned. So let's have a look at the historical returns of the fund, and let's compare that just, to ZLB. So this is ZLB is the boring Canadian low volatility ETF. And let's compare that to ZLH, which is the low boring volatility US ETF. And let's have a look at what they've done. So HAC has delivered, in line with these ETFs over time, a low, boring, decent average return. 2 thumbs up. I like Brooke. I like what he does. He's tactical. He's active. And I think, adding that to your mix of portfolios is probably a good idea. For the S&P 500, I can see ETFs in the US currency or hedged to Canadian currency at BMO. Can you help me understand the benefits of both? Should I buy a little of both? What is the strategy and what makes sense for Canadian residents? So again, let's go back to our slides. I have a Canadian screen that I had set up, and here it is. So this is the candlestick chart of the Canadian dollar. The 2 key factors that drive the Canadian dollar are this green line, and that green line is the spread of interest rates between the US 2-year and the Canadian 2-year. And the direction of that spread attracts capital to Canada or to the US that's looking to place money and get a yield. Okay, so that's one proxy. And the other proxy, folks, guess what? The price of crude oil. And so when you look at what pushes and pulls the Canadian dollar, sometimes when this pink line is rising, oil prices are falling. When this green line is rising, more capital is attracted to the higher rates in the US than in Canada. So you've got capital leaving, oil price falling, we're not getting paid as much for our oil. So bearish Canadian dollar versus the other way around, oil prices rising, Canadian interest rates higher than the US, money coming into Canada, Canadian dollar getting stronger. When this chart falls, the Canadian dollar is getting stronger relative to the US. When it's rising, it's weaker. So should I buy the hedge version or not? You've got to look at the chart and take a view over your investment horizon. So we can take a back snapshot of this. What some of these lines are on the bottom are some of the volatility metrics of what's volatility's pricing at, like the VIX for the Canadian dollar. So I look at some of those things too. And then we have our RSI overbought, oversold. So when we're at the top, and when volatility is spiking, and I get a combination of spiking volatility, so we're up here, for example, I want more exposure to the Canadian dollar. We're at an extreme one way or the other. And when we're at the bottom and volatility's contracted, and these metrics of oil prices and interest rates are lining up, I want to be hedged. So that's what I do. If you can create somehow some way to track it, you can do that. But over time, you have to take a view on the currency, where it's likely to go based on the things that push and pull it. And for me, my default is I want the pure exposure to the US market. So if I want to invest in the S&P 500, I buy the S&P 500. And my default is to buy the hedged version, okay? So I want the pure return of the market with the hedge on it. But if I think that the Canadian dollar is going to get weaker, I want exposure to the US dollar, I will own the unhedged version and have that US dollar increase my returns. So I think about the hedge or non-hedge as a completely separate decision over time. Now there's a cost to hedging, and there's the cost to hedging is a cost, and over time that could be 30, 40, 50 basis points. The cost of hedging is the relative difference in interest rates between the two currencies. Okay, so which one do I do? The default for most people is to go unhedged. And at times, so let's say the Canadian dollar weakens, but the US market goes up. You could have no return at all from owning the S&P 500 because you've lost it all in the currency. So your currency call is pretty important, and all these things factor into my currency call. So hopefully that answered your question there. And so the answer, should you buy a little bit of both? You know, again, depending on your time horizon as to what you do there. So I've been following you for some time and watching now, and I've been building ETFs and slowly increasing my US dollar stocks by converting CAD to US dollar at CAD peaks. And recently, CIBC launched fractional access to US stocks with a hedge through NEO. And I've been picking up some of those US stocks with CAD. Do you have any insight on the benefits and risk of this approach to gain US exposure on Amazon, Facebook, and other high-priced US stocks? First of all, I don't like Facebook at all. At 140, 150, I get interested. Amazon here, I don't like it. At the current price it's trading at, low 2000s, I get interested. But I think it's a great new innovation and a way for us to get exposure on a hedge basis to US stocks. So I love what they've done. I just wouldn't buy any of these stocks right now. So great question. When the Canadian government lifts the mask mandate nationally, which sectors will be the most impacted, and where is the opportunity from an investment standpoint? So here's the thing about the Canadian market. the only real good company to trade that from a restaurant, a reopening perspective, might be Tim Hortons, right? Think about it. How many Canadian companies own restaurant brands that will benefit from reopening? Movie theaters. Like we don't have a robust investment universe here in Canada. The one that comes to mind would be, shopping malls. So the underperformer in the REIT sector has been retail REITs, stay at home, less mall traffic. As that starts to come back, that might be the opportunity to underweight office and retail REITs that have lagged and reduce the industrial REITs and the apartment REITs that have gotten pretty expensive at this point. So there's one idea for you. Can you explain briefly what happens on the LME regarding the nickel trading and the effect there? So that's a great question. So on the futures market, they have limits. And so a futures contract can only trade certain price. Now, back in a previous job when I was a much younger version of myself and could handle the leverage and volatility of futures, I traded on a futures desk. And I've traded everything from lumber to nickel to S&Ps to bonds and you name it. And got registered as a commodity trading advisor. And at one point, I was this close to buying a seat on the floor of this CBOT to trade commodities and bonds and interest rate markets in particular. And life being what it is, decisions made regarding family, I never ended up going to Chicago. But story for a day. If you ever see me at a bar one day and over a beer, ask me about that, and I'll go into it some more. But you have these limit markets, and so whether it's wheat or nickel, and the exchange literally shuts down and you can't trade. And sometimes when you get into these squeezes, for efficiency and safety, they shut the markets down. And that's kind of what's happening to some of these markets that have been impacted in particular by the Ukraine-Russian war. You get a weather market, you get limit markets in wheat and corn that are impacted by, drought and excess precipitation, and you get lumber markets where you get, supply side issues or demand side pull, and you get big limit moves. And so it happens in commodity markets. And, if you don't understand them, folks, just please don't go there, because you can really lose a lot of money trading leverage and commodities. Hopefully that gives you some answer there. I'm mindful of the time here. We've got about 7 or 8 minutes of questions to go. So with the current gas situation in the Ukraine, are there opportunities in green energy and nuclear? I've said for a couple of years now, I love nuclear. I've had exposure in my growth portfolios, in URA, in my equity portfolios. I don't speculate in the juniors, but I've had a core position in Cameco. So recently I'm out of Cameco in my stock. I'm buying every little dip and adding back, but we're a bit overbought here. A lot of good news out there, and usually you want to sell into that. If you're a trading type like I am, I still have exposure to uranium sector, but looking to lighten up into strength, but equally as aggressive as a buying weakness. I've been adding to the green energy clean ETF. I love hydrogen exposure. I think green energy is the future. The stocks aren't cheap. Many of these companies don't have stable earnings, so they are impacted in a negative way as inflation picks up and the uncertainty of earnings in a slowing economy. Investment in green energy will naturally slow down as the economy weakens, despite the ESG movement, which is a trend. So you've got a cycle within a trend that's a bit of a headwind now. So yes, so great question, and there are ways to play those. What's the outlook on technology for the next 6 months? If I could do a big banana for a moment and go, that's kind of what I think about Shopify and Arc, and those are going to be great buys again at some point, but right now it's more like buy and sell the rips. You can be a trader, not an investor. So there was news of a fertilizer shortage. Russia, in particular, huge exporter of nitrogens and fertilizer commodities. So it will impact the global food chain. I did talk about that. These stocks are ripping. If you look at what analysts think they're worth, we're way overbought. Trade them. They're not investable at this point because they're well above their fundamental values. To the extent that you think Russia will permanently be a detractor from the global supply of fertilizers and a permanent increase in price, different story, but the analysts don't believe that today. Maybe that's the future. Stay tuned for more info on that. I'm not in them. The U.S. has a strong relationship with Saudi Arabia, assisting them in various wars. Absolutely. Why are the Saudis not producing more oil for the U.S. and helping with dramatic? So Saudis are selling their oil. They're selling Aramco. They're not investing in this. They know that it's a green future, and they're converting their oil wealth into real estate and other cash flowing instruments because they know the future is green. And again, 10 years, 20 years, 50 years, 70 years from now, what Saudi has is sand. And they want prices up. Now, the world doesn't work well with oil prices over $100. Pushback from truckers and individuals and mom and pop and the price of gas. And I love Pierre Poilievre, but it's not Trudeau's fault. And, but ESG is a huge factor here. And as hurt as many of these guys got when oil prices went negative, they're getting their payback now. If the world needs oil, they'll pump it, but they'll pump it slowly and they'll be very measured. OPEC lost control when the fracking boom took off. They're very mindful of that, and they want the control back, and that's, I think, why we're seeing there. So, great question. Seems that individuals like you with fiduciary responsibility. So fiduciary responsibilities means as a portfolio manager and asset manager, I can't think about anything else but my client. Okay, my responsibility is to my client. So having been entering orders on your Bloomberg terminals that protect the interest of your clients, but have a negative impact on the Russian economy, selling Russian assets or whatever it is, would you comment on the cumulative impact of these individual decisions? So I'm not selling Russian assets today because everything's frozen and I don't have the ability to do that. Last night, Russia Stock Exchange reopened and they were able to start trading some of their stocks again that have been under sanctions, and where there's a US ADR that represents those companies, the Gazproms, the Mobile Telesystems, there's a handful of them, there's probably a couple dozen. I can't trade those still today. They don't trade on the North American exchanges. So, I get where your question's going to, and I tweeted something out recently. I think it was a G0 Media that it came from. We need the Russian people in the world. We don't need the Russian autocracy. And the social impact, the war, we know mutually assured destruction, both being NATO being and Russia being nuclear, we're not going to go there, folks. We're just not. I don't believe Putin can push the button by himself. Maybe he can, maybe he can't. I showed that video before. Maybe the people under him are worse. I don't know. The people that I listen to that should know those things say that there's a layer under him protecting him that want the same things as him. So are they going to create a Tiananmen Square if there's an uprising and a movement to get him out of power? And so these are great questions, and they're great to discuss and debate. But the world has sanctioned Russia, except for China and a few other friends of Russia. Listen, it's hard for Xi right now because Xi wants Taiwan, and Xi's social governance of Uyghurs, and you can go into child labor issues and China's autocracy and communism. But what Russia never embraced was the Western capitalism. And they tried, but really this underlying discussion that the former Finland Prime Minister was talking about earlier in the presentation, that cultural part of that part of the world is embedded. And I think it's sad, because I think neoliberalism and freedom is the economic model, but it has caused tremendous inequality. But I would argue the oligarchs and the thievery in Russia has been far worse, the haves and has suppressing. At least in the neoliberalism model, you have a chance. Anyways, folks, it's been a great 90 minutes. We are out of time. Thank you so much. Please, please, please consider sponsoring one of our charities, and I will be thrilled to match it. Make your portfolios boring for the next couple years. Have a great week, everyone.